Welcome. Today we're going to break down a crucial and often misunderstood topic in taxation, tax loss carryovers. If you've ever had a tough financial year, you might have wondered if there's a way for that loss to provide some sort of tax relief in the future. Well, the answer is yes, and understanding how is key to smart financial management.
Let's dive right into the material.
All right, here's our roadmap. We'll start with the foundational concept, what these carryovers actually are. Then, we'll dissect the two main categories, net capital losses and non-capital losses. From there, we're going to get our hands dirty with a practical calculation example to see how it all works in the real world. And finally, we'll discuss the art of strategic timing, which is where planning can make a huge difference. So, first things first, let's establish exactly what we're talking about when we say loss carryovers and why this concept is so fundamental to our tax system. You can think of it as a sort of financial shock absorber. The tax system recognizes that income, especially from business or investments, isn't always a straight line up. You have good years and you have bad years. This provision allows you to smooth out that volatility, preventing a single bad year from unfairly penalizing you while you're paying high taxes in profitable years. Now, before we go any further, there is one absolutely critical rule you have to remember. It's the golden rule of loss application. You must always deduct the losses from the current year first. You don't have a choice in the matter. You can't save this year's loss for the future while using up an older one. Only after the current year's losses have been fully applied can you start to use any losses you've carried over from previous years. Okay, let's look at our first major category of losses. This one has a fantastic benefit, but as you'll see, it also comes with a very specific restriction. So what is a net capital loss? Well, it's pretty simple. It happens when your investments have a down year. If your capital losses are more than your capital gains, that excess loss isn't just gone. It becomes what we call a net capital loss, which you can then carry over. And here we find a classic trade-off in tax law. The upside is huge. You can carry these losses forward indefinitely. There's no expiry date. But the catch, and it's a big one, is that you can generally only use these losses to offset capital gains. They can't reduce your employment or business income. Now, there is one major exception. In the year of an individual's death, any remaining net capital losses can be used to offset any type of income, which can be a significant planning point. Now for the other side of the coin, non-capital losses. These offer much more flexibility in how you use them, but they come with a deadline. You can think of this as the catch-all category, when you have losses from your business operations, rental property, or even a specific type of loss called an allowable business investment loss, or ABIL, and you can't use them all up in the current year. They get bundled together into what we call a non-capital loss. So what makes these so valuable? Their flexibility. You can apply them against any source of income, employment, business, investment, you name it. But here's the limitation. There's a 20-year clock ticking. You have to use them within that time frame or they expire. And watch out for that ABL exception. An allowable business investment loss has an even shorter fuse, only 10 years. And if it's still unused, it doesn't just disappear, it gets reclassified as a net capital loss. This chart really lays out the central strategic choice, doesn't it? With net capital losses, you get longevity. They last forever, but their use is restricted. With non-capital losses, you get flexibility. You can use them against anything, but they are temporary. Understanding this trade-off is absolutely fundamental to tax planning. Now, just a quick note. While we're focusing on the two main categories today, I do want to point out that there are more specialized categories. Farm losses, for example, have their own very specific set of rules and limitations that are important for anyone in that sector to be aware of. Okay, theory is great, but tax concepts really come to life when you see the numbers in action. So let's walk through a detailed, step-by-step example together to see exactly how these rules play out. So here is our taxpayer situation across 2 years. If you look at year one, you can see we have a bit of everything: employment income, business income, but also a big business loss. We also have capital gains and losses and that allowable business investment loss we mentioned. It's a busy year. All right, let's break this down for year one. We always deal with capital items first in their own silo. Our taxpayer has $8,000 in capital gains, but $13,000 in capital losses. So the first $8,000 of those losses wipes out the gains. That leaves an extra $5,000 in capital losses. That becomes our net capital loss that we carry forward. Okay, now for everything else. We add up the positive income, $12,000 from employment, $20,000 from business, and $2,000 from other sources. That's $34,000. Then we add up the other losses, a $50,000 business loss and a $6,000 ABL. That's $56,000 in total. We use $34,000 of those losses to bring our taxable income for the year down to zero. We're still left with $22,000 in unused losses, and that becomes our non-capital loss to carry forward.
Now we move to year 2. Things are looking better. Our taxpayer has $20,500 in net income. Let's look at the components. First, the capital side. $4,000 in gains and $1,000 in losses for a net capital gain of $3,000. Perfect. We can use $3,000 from our net capital loss pool we carried over to wipe that out completely. So, our $5,000 net capital loss balance is now down to $2,000. Okay, that still leaves $17,500 of other income. So we dip into our non-capital loss pool. We use $17,500 from that carryover to, once again, bring our taxable income down to zero. Our original non-capital loss balance was $22,000. So after using that amount, we have a final balance of $4,500 left. So going into year 3, our taxpayer has 2 tools ready to go: a $2,000 net capital loss and a $4,500 non-capital loss.
Understanding those mechanics, that's the science of it. But knowing when and how to apply those carryovers we calculated, that's the art of tax planning. This is where you actually get to make decisions. So the big question is, when should you claim these carried over losses? The knee-jerk reaction is to say immediately, but that is not always the most beneficial strategy. You see, it's a balancing act. Of course, using the loss now gets you a tax refund sooner, which is great for cash flow. But what if you expect to be in a much higher tax bracket next year? That loss deduction will be worth a lot more if you save it to offset income that would have been taxed at a higher rate. It comes down to certainty. How sure are you about that future income? And of course, you can't forget that ticking clock on the non-capital losses. This leads to a very common and prudent strategy. If you have both types of losses at your disposal, it often makes sense to use the non-capital losses first. Why? Because they have that 20-year expiry date. You want to use them before you lose them. The net capital losses, on the other hand, can wait patiently, indefinitely, for a year when you have capital gains to offset.
And let's just hammer this home one last time, because it frames every strategic decision you make. You have no discretion over current year losses. The law says you must use them. Your strategic freedom, your ability to plan, only kicks in with the unused amounts that are carried over to other years. That's your playground.
And that is the central strategic dilemma I'll leave you with. It's a calculation that involves more than just numbers on a spreadsheet. It involves your personal financial situation, your tolerance for risk, and your expectations for the future. There is no single right answer. The right answer is the one that's right for your specific circumstances.